Withdrawing things can be challenging. Often people don't agree on means and ways. Few things are as simple as withdrawing this trash. Just pick it up and get it out. But if you recall, a couple months ago, the entire government shut down for a record number of days over a fight to whether or not withdraw your Affordable Care Act subsidies. Was that same angst and fight applied to the National Defense Authorization Act? You know, the one where after the Pentagon slightly hinted they may want to withdraw troops down from Europe and South Korea, maybe even Syria, because, you know, they're not quite the major national security risk that all that money is saying it is. Well, of course not. We've seen impressive bipartisan support for a law that would now mandate troop numbers over in Europe and South Korea, missile funding and sharing with Israel, and a slight $8 billion more in money than the already $800-some billion the president asked for. It's crazy how Congress can come together and find a solution when the right thing is proposed to be withdrawn. But I digress. There are also two very interesting ways on how to withdraw cash value from life insurance. Once you do it, this transaction is written in stone. There's no going back. You take money, they take death benefit. Problem with this is that if you happen to take out more than you put in, the IRS will come calling for capital gains tax, so you got to be careful. The second is the more popular, and it's known as the policy loan. Now, the policy loan on life insurance is very interesting because you can actually take money out and still receive interest on that money as if you never did. You see, when you loan money out of a life insurance policy, you are actually only reducing the balance sheet of the cash value account. That's the money you get back if you were to surrender the whole thing. But there's another account called the policy value account, and that's the balance that your actual credited interest is based off of. And so if you loan that money out to yourself, yes, you will be charged some 2 to 3% annual loan interest rate, but the very amount that you took out will still sit in the policy value account accruing interest. And what we often see is that additional interest accrued is more than able to make up for the 2-3% you're actually being charged for the loan. The death benefit is only reduced by the policy loan, but you have the option to pay that money back. And then you've got taxes. As long as you take that money out and you still leave enough in there to have an active life insurance policy, you can take out profit without the IRS coming for capital gains. So withdraw wisely.